I'm surprised they pay a dividend at that.
We rather have it that way than the other way around. He bought it on short-term problems. I want to own forever. That's the key when looking at companies. American Express, guys. This company was up a lot last week. They crushed on earnings. It's still going up. This is a major holding of Berkshire Hathaway. Warren Buffett loves it. He bought it when it was not looking good, though. The company was having problems. That's the key I want you to remember. He bought it on short-term problems. He believed in the brand. He believed in longevity, and he thought it was a temporary problem, and he was right. So if you're new to this channel, Mo and I are value investors. We separate the company from the stock price. We value the company based on its fundamentals and financials, and we believe in the long run, if we pay a reasonable price to the company, that our stock will follow basically the fundamentals of the business. That is the main key with value investors. American Express is a great brand. It is one of my 20 or 25 stocks that I want to own forever. So let's use our software to figure it out. All right, guys, American Express, all-time high was February of last year. It's almost a year ago, $199.55. 8 months later, it hit a low of 130, and now it's back to 175.
Wow.
Yeah. Now, a lot of big difference between enterprise value and market cap. A lot of debt there. I'm sure it has to do with their financials being
For sure.
Yeah. Anyways, some key attributes here. Pretty consistent profit margin, 14 to 15%. Dividend yield. 1.5 billion gets you 1.2%, and they can easily afford that. Their 5-year average free cash flow is 10.5 billion. This is less than 15% of their 5-year average.
I'm surprised they pay a dividend that is that low, actually. I would have thought they would pay a little bit more out.
Yeah, I would have too. Now, we have no return on invested capital here. That's not because of any other reason than the way in which we calculate our return on invested capital. I'm quite sure it's quite high.
I guarantee this is over 9%.
Oh, 100%. Look at MasterCard.
I wouldn't be surprised if this was 15%.
Look at MasterCard. Their 5-year is 56.6%. And it's pretty much the same kind of thing. Let's see what Visa's is. Visa is 19%. So I'm quite sure American Express is a really, really high return on invested capital. All right. Now, let's check out the 8 pillars. Now, obviously, there's not enough data for the return on invested capital. Okay, they bought back 12.8% of their shares. Look at this. 5-year price of free cash flow, 12. 5-year PE, 21. I like the fact that they have a lower price of free cash flow. That means they're making more cash flow than their earnings show. We rather have it that way than the other way around. It's harder for a company to defraud people by faking cash flow, right? Yeah. One of the things that exposed Enron was they reported earnings of this and free cash flow of this, like literally 1/10. And people were like, how is this possible? That's the key when looking at companies. I want to see the same free cash flow. And if not, I want to see it higher or an explanation as to why the free cash flow is lower. As an example, Netflix has a big discrepancy between earnings and cash flow. Earnings are much higher than free cash flow. That's what puts it in the too hard pile because I'm not understanding how they're depreciating certain things, et cetera. So it caused a little confusion for me. Yeah. All right. So analyst estimates. Okay. All right. So about 25% growth over the next 3 or 4 years. Nothing huge.
No, but consistent.
Yep. And revenue growth. Yeah, guys, it's already a very mature company. Now, the key for this company is if you're able to buy it for a price that makes sense, and as it goes lower, buy more shares, you're going to do very well over a long period of time. But you're not going to make 20% returns in this company. No. That's not going to happen. But you should be happy making double-digit returns on a very, very safe investment. That would be the goal on American Express. Monish Prabrai talks about Guy Spear loving MasterCard, and he keeps telling Guy, you're not going to make huge returns on MasterCard from here on out. Because Monish's mentality is, I want to keep getting in and out of stocks that I can sell and find hidden value. Yeah, multi-baggers. Yeah. Guy's sitting there probably like me and saying, listen, I'm lazy. I want to do less work. Yeah. I want to find great companies that I bought at a great price.
Or you have a basket of stocks where you do this with, and then you go for the multi-baggers in some other area.
Correct. And that's what I do. Yeah. So guys, it's not like I'm giddy as a schoolgirl for this, but let's go to the stock analyzer tool. Now, since it's a company I want to own forever, I'm going to use 20 years of analysis. Mo's going to do 10. But before we get there, I hope you've noticed there have been no YouTube ads on this video, and we're doing that to focus on the content and our software. So if you're interested in getting all the software here, plus access to our community, check out this video. For the next minute, I'm going to explain to you our software at everythingmoney.com and how you can use it to retire with more money than you thought possible. Do you get anxious every single time the market dips? Do you feel like maybe you're behind on your savings? Is it ever a worry that you may not have enough money to retire? If you've answered yes to any of these questions, then our software is absolutely perfect for you. With these easy-to-use tools, and our community with thousands of other like-minded investors in there. You can use all of this to have better peace of mind and to understand why you are making the decisions you're making, because it's more about the emotion and temperament than it is about the numbers. And these tools, especially this community, will help you realize that and make better decisions going forward. You will absolutely be able to understand financial statements and impress your friends who still waste their money buying stocks based on their emotions and other hype people out there. So for a little over $1 per day, less than a cup of coffee, eliminate that fear from your life of worrying about your future financial state and your retirement savings, and try our software risk-free for 30 days. If you don't like it, email us, money back guarantee, no questions asked. Go to everythingmoney.com, sign up now, and change your financial future starting today. All right, guys. So we're going to look at revenue growth and make our assumptions for low, middle, and high revenue growth, profit margin, free cash flow margin, PE, price of free cash flow, and finally our desired return. Mo, you put yours in for 10, I'll do mine for 20, then we'll compare.
Okay.
All right. So this is where the art of investing matters, guys. We have to sit here and figure out what are the right numbers. Oh man, look at the difference between free cash flow and profit margin. It's huge.
Yes, it is big.
And it's getting higher for free cash flow, ironically. Okay. All right. Yeah. All right. So while Mo's doing his, I did revenue growth of 3, 5, and 7% over the next 20 years each year. Mm-hmm. Profit margin, I did 13.5, 14.25, and 15. Free cash flow margin, I did 21, 24, 27. PE, 15, 16.5, 18. Same with price of free cash flow. Now for desired return, I usually do 12% here, guys, but I want you guys to see that I already beat this one up so much. I'm okay getting my 10% return here. If I can buy this company for whatever price pops up over here, I feel like I'm going to get that all day. And I think that has ample margin of safety in and of itself, because you can get 9 or 10% from a long-term ETF. So as you make higher and higher assumptions, your desired return should go higher to apply more margin of safety. Mo, what were your assumptions?
I've been going back and forth. Revenue growth, I did 4, 6, and 8. Profit margin, 13.5, 14.5, and 15.5. Free cash flow margin, 21, 23, and 25. And then for PE, 13, 15, 17, same for price to free cash flow. And my returns were 12, 13, and 14%. And I'm noticing right now it's on my watch list at 120. So we'll see what the number spits out.
So it's on my watch list now at 150. And this is kind of hard. So my numbers came out as this. Ready? So the problem is because of earnings versus discounted cash flow. Right. Discounted cash flow method, all day long. All day long.
Same here.
Earnings in the 130s. So I'm looking at going, listen, this is a hard one. I could justify buying it at 150 if I really believe these numbers. Because look, what's in between these two?
Right.
So guys, this is the art of investing. I have it on my watch list at 150. When the stock hits 150, I'm going to start selling aggressive shares of it, aggressive puts. And if you want to learn more how you can do that, watch more of our videos. But guys, don't forget to subscribe. And thank you very much for your time. The more you learn, the less you fear. And that's what's the most important in investing.